Hi everyone, Leslie Batson here. Welcome to another episode of Rebel Rock Money Talk. Thank you so much for tuning in. If you have not already, please don't forget to subscribe to our mailing list. You can just go to rebelrockwealth.com and just scroll down to the footer and you'll see where you can sign up for our mailing list. Also, if you would like to follow us on YouTube and on LinkedIn, you can find us there, rebelrockwealth.com. So I wanted to talk a little bit today about my kitchen, my kitchen remodel, in fact. So this summer, I was on a Zoom call and I all of a sudden randomly heard this strange noise. So I left my office. I was like, hold on one moment. I left my office, went out, and the sound was just getting louder and louder as I approached my kitchen. As I went around the corner around my peninsula, I just saw this water streaming out from the cabinet under my sink. And I was freaking out, but I reached under the cabinet to turn off the shutoff valve, and guess what? Nothing happened. So the water just continued to stream and stream and stream. I ran outside to try to figure out how to turn off the water to my house outside, couldn't figure that out. And so it wasn't until a plumber showed up an hour later that the water was able to get shut off. So imagine having water streaming for an hour. I had used all my towels that I had owned. I had to push my furniture out of the way because it was seeping under the cabinets, even under like one of the walls. It was seeping out into my garage. It was a nightmare. Okay. But thankfully, when the insurance adjusters came out for my homeowner's insurance, when they came out, they reviewed everything and he was like, yeah, these base cabinets are destroyed. You know, we're going to, accept your claim. So I filed that claim and I received a check from my insurance company to cover the cost to replace the cabinets. Okay. So when I received that check from my insurance company, it doesn't come to me as income because I have been making premium payments to this homeowner insurance policy for the purpose of replacing a loss in the event that one occurred, right? So unfortunately, I had a loss and they were able to, send me the money. So I don't have to pay income taxes on it. It was replacement of a loss. So a couple weeks ago, episode 30 of the podcast and the email newsletter I sent out, the Rebel letter I sent out a couple weeks ago, was referring to the changes that are proposed in making changes to the IRA and Roth conversion and some other things related to qualified plans. And so I've had a few people ask me since then. So first of all, thank you for listening to the episode. But I had a few people ask me, am I concerned that now if they, if they've been proposing changes to IRAs, am I concerned that they'll start proposing changes or like tax law changes for life insurance? And so my short answer is no, right? So very similar to my kitchen, right? I had an issue. I had been making premium payments all along. When I filed a claim, that money came to me income tax free because it's not income, right? It was for the purpose of replacing a loss. With life insurance, it's the same thing, right? You're making premium payments all along for the purpose of that death benefit, which is to replace a loss once the insured passes away. Okay. So the tax changes that are being proposed for IRAs is specifically for retirement money. That is what qualified plans are for. 401ks, IRAs, Roth IRAs. I mean, those are retirement plans. They're different actually products that were created by the IRS, right? So the IRS created these products or let's just call them vehicles, right? They created these vehicles for the purpose of saving. So they can manipulate and change the rules of their products, right? They can do that. But a life insurance policy is a contract. It's a private contract between you and the insurance company. Okay. There haven't been any tax laws proposed or changed since 1986, when so many wealthy people were dumping money into life insurance policies that they realized how much tax revenue that they could potentially be missing out on. So they implemented something called the 7-pay test in 1986. And so that just meant that instead of dumping a whole bunch of money at once in lump sums, as what we would say as single premium, people now have to, put their money in over time, right? So there's sort of the 7 pay or 7-year test that's done just to make sure that, money's going in a managed way. But that's about as much influence as, or I should say, as much, changes to life insurance. And of course, that specifically only affects like whole life insurance, universal life. It doesn't affect term. It doesn't affect the non-permanent type of life insurance policies. Okay, but that's the last time that those changes have been, introduced, and that was, almost 40 years ago. So I'm not concerned because, again, these are not life insurance, or specifically whole life insurance policies, are not retirement vehicles that the government created. These are contracts that you have between you and the insurance company, and it's just a separate set of rules. Okay. But I have 6 other reasons that I also believe is why we wouldn't see, at least I would not expect to see any tax changes, tax law changes proposed. Okay. So let's say the second reason is kind of what I just alluded to, is that the first job of life insurance is to replace a loss, and that would be a loss of life. So you're paying for a product, right? It's just that the life insurance policy also has the ability to provide the savings and all these other tax benefits while you're alive. Okay. That just is sort of the bonus. But because the primary purpose is for the death benefit, it's a very separate, it's like apples and oranges, IRAs compared to life insurance policies. Okay. My reason number 3 is that they are after tax dollars that are used to pay for your premiums, right? So you've already paid income tax on the dollars that you use to make your premium payments. So the IRS has already collected their taxes from where that's concerned. Now, yes, the money that's growing within your policy is tax deferred, but it's different from an IRA or 401k, because there's really no way to get that money out of a 401k or IRA without paying income taxes. That's a very different situation when it comes to your whole life insurance policy. Okay. Reason number 4, as I alluded to, laws haven't changed since the 80s. I can't see that happening now, at least not that severely. There was a change that was just proposed or passed in December, or maybe it was January. I think it was January of 2021, where the guaranteed interest rate was allowed to be reduced from 4% to 2%. But this is something that the insurance companies actually requested. And it's because the interest rates have been so low for the past decade that it's been, a little tough for them to be able to keep up and grow their money as they need to, so that they can make sure that they have money down the road to cover your claims. So by having this allowance, this ability to go from a 4% to 2% guaranteed interest rate, it actually provides a higher MEC limit. So that just means that it actually allows you to be able to put more money into your policy than you might have been able to before. So it's actually a very good thing. It didn't work to impede or hurt people's growth if they have a life insurance policy. Reason number 5. Okay, so touch on this as well. So the IRS has no ownership on a life insurance policy. Again, it's a private asset between you and the insurance company. So the insurance company can modify, certain rules around how they've designed their policy for you, but the IRS doesn't have that say. Okay. So the next reason, number 6, you may not have ever heard this before, but there are 2 terms, BOLI and COLI. Okay. BOLI is BOLI. It stands for bank-owned life insurance. And COLI stands for corporate-owned life insurance. Now, these are policies that, either banks or corporate executives, or banks put onto their executives, or corporations have on their executives. And this is really a way to offer some, it's basically an employee benefit. It offers some incentive to high-level executives, whether it's corporate or bank. And they are able to tap into these funds to pay for employee benefits. They may share some of the cash value with the employee themselves. It's really like incentive based. But there are billions of dollars of BOLI and COLI policies out there across America. It would be shocking if the tax laws were changed, that would hurt that because, as we know, um, the tax laws tend to favor corporations. Okay. So I would be surprised if tax laws were changed in a way that it would hurt the tax benefits that we all get have come to enjoy from like whole life insurance or permanent life insurance. Reason number 7 is the like I mentioned, the privacy, right? It's a vehicle that's been used by the wealthy for over 200 years in America. Okay. So it would be shocking to me if the laws would change in a way that it would hurt that segment significantly, right? So the reason that the wealthy like it is for the privacy. As I said, you don't have the IRS involved there, right? When you file your taxes each year, you're not filing a 1099 of what's grown within your life insurance policy, right? It's kept private between you and the insurance company. So you have the privacy, you have the liquidity, you have the access, and you have the full control, right? So like I said, since 1986, there haven't been any laws that have been passed that have, impeded or hindered the ability for the monies that are held within life insurance policies to be hindered, right? That wealth has been able to continue to grow. You have that uninterrupted compounding. And whereas we've seen that it's changed with IRAs, even just we look at the last, 2 years, how many times have IRA laws been changed for the purpose of the IRS being able to collect tax revenue, right? And it's like, it's not a criticism, right? It's like the government doesn't make widgets, right? Their revenue is our tax revenue. That's how they are able to, make things work. So they need to find creative ways to be able to, get access to tax dollars. And so they're modifying the rules of these different retirement plans that they've created, and people have chosen to put their money into those vehicles. So they have to be just mindful of when those changes are being proposed because you want to know how it affects them. So you also want to be knowledgeable in other places that you can put your money so that you can avoid these types of surprises, right? You could be planning one way for years and then all of a sudden this rule pops up and it could be backdated, right? These changes that are being proposed right now, if they are passed, some of them will be backdated to, I think it was September 1st of 2021 when they were proposed, which is, a little ridiculous, but that's what's being proposed. Some of them, it might be effective January 1, 2022. But either way, the point of that podcast episode a couple weeks back was to just raise your awareness that there are changes that are being proposed to the tax laws that could affect your money growing in those types of accounts. And so when I'm asked, am I as concerned about the tax law changing around life insurance as what's been proposed for IRAs, I'm not as concerned. So just wanted to share why I'm not as concerned. Okay, so hopefully this was helpful. I don't necessarily want to talk about this every week, but I know that this is a pressing concern for many of you, and I've been getting the questions, so I wanted to answer them for you. And if you have any other questions at all related to personal finance, wealth building, tax reduction strategies, personal finance at all, just give me a shout, let me know. You can send an email to hello@rebelrockwealth.com, or you can just leave it in the comments. And I would love to see them. I'd love to get your feedback and get your questions, and maybe I'll cover it on a future episode. Thank you so much for tuning in. Have a great day.